Last episode, we talked about the advice contractors hear all the time. Just buy that truck and write it off. Today, we're going to run the numbers and prove the math behind that potential mistake, the second half of the story that sometimes comes back like a boomerang nobody saw coming. Today, we're showing you things you may never have thought about that may be killing your construction cash flow. This is the Contractor Success Forum. I'm Wade Carpenter with Carpenter Company CPAs, alongside Stephen Brown with McDaniel Whitley Bonding and Insurance. And Stephen, this was your original brainchild. Can you recap what we talked about in the last episode and your thoughts for today?
Sure, Wade. We talked about what is a write-off. Do you buy? Do you lease? What's the effect on your cash flow? What are the emotional things behind this decision-making process? What about a myth that you hear about something or advice from someone who's like, no, I tell you what, my accountant's got me doing this and it's been fantastic. Does that necessarily apply to you in your situation? So what we talked about last time were all these questions that contractors have about writing stuff off and what that means. And you were going to show us in this episode the actual numbers behind the write-off, the purchase, of whether it's a good idea or not. Or does it really make sense? We talked about too, what is the right questions to ask as well when you're trying to make this decision? And what does it look when you plug it in and just crunch the hard numbers about what really makes sense? So I can't wait to see your latest calculator and advice on this. Thank you.
Well, as you said, there's a lot of myths out there. We also talked about lease versus buy and then repair, replace. Some of this common advice out here that contractors hear. Does it matter if your own sole decision is just, can I deduct it? Is that deduction killing your business? We're going to explore a whole bunch of things in this episode. This is not about a PowerPoint or anything like that, but what is the right question to ask here? Does that purchase actually improve your business financially? Or is it something that, can this company afford the payments if your revenue tanks, if you hit the slow season, those kind of things? So we're going to jump into that and maybe attack some of those things. I'd just like to start with the lease versus buy and the equipment financing part of it.
I think that'd be great. Yes. I get that all the time. And when I'm asked that question, I say, well, I'm sorry, you're going to have to talk to your CPA about that.
So let's just take this in pieces. But what I'm really hoping our listeners will do is stick around till the end, because this is where the aha math is going to come in. It's like, okay, maybe I've never really thought about that before, but all this sort of leads up to it. We could play with numbers here all you want. Let's just say we started with an $80,000 truck. We put $10,000 down and we had, say, a 7.5% interest rate. How does the interest rate play into it? We're going to lease it versus buy it. And right now, we're not really getting into the depreciation and all the tax effects of it, just the economics of it. What is the cash flow and drivers of this? This is more of a question of cash flow, right? So I see you, I know I haven't shown you this.
Yeah, no, I mean, sure, you're above water $1,112, but then you've just put a $10,000 down payment down on it. So you no longer have that cash.
This is just a model, and what we're looking at here is, yeah, you can say, okay, depreciation, we can write the whole thing off, but economically, I know you sort of threw this out there, and I don't know that's the right, but if it's 30% the moment you drive that truck off the lot, and it's not just about trucks, it's your equipment, whatever you got, should you lease it? Should you buy it? From the standpoint of cash flow, that's what we're talking about here. So you can say, if I pay that off in 60 months versus if I would do a bigger down payment or whatever that down payment might be, it's a cash flow decision, right? But what we're going to get into later is, yes, we can take it just from this standpoint. We've got a loan and we back into a monthly payment. It's going to cost us right at $1,300 a month in this scenario. So say we decide we're going to sell it in that year two, depending on what that truck value might be in year two, could you sell it for $51,000? What's it going to be worth at that point? If you've run the wheels off of it in year two or year one and you got 100,000 miles on it already, what's that truck going to be worth?
That's a good question.
We could play with the calculator all day long, but what we end up doing is getting in this negative equity thing. On average, if the truck depreciated 18% per year, and what's your loan balance versus your truck value, at some point you get into this underwater zone. And this is what a lot of people don't understand. This is what vividly came out in 2008 when people were upside down on loans and they couldn't get out of their trucks. They couldn't get out of the excavators that they couldn't make a payment on. This is what I talked about last time. And you were shaking your head. I imagine you remember when those contractors had to bring money to the table to get out of making that monthly payment.
What a nightmare. Yeah.
So, are you following where I'm going with this? This is more of a cash flow decision.
We're looking at it from a cash flow standpoint, but we're also looking at the value of it itself. I always think of the value of any equipment that a contractor owns as what it's worth at a fire sale.
Well, that's exactly where I was going with this. You end up owing more on that truck than it's worth. It's almost like that boat taking on water. The longer you ignore it, the deeper you're going to sink. When we get into the later calculators, we're going to see how sometimes that becomes a spiral. Why these contractors can never get out of this cash flow spiral that they get in. This is how these contractors get trapped in this rolling debt. I don't know if you've ever seen it, but I've seen it quite a bit at certain times where they try to get out of this truck and they go in financing more than the truck is actually worth because they roll in the trade and they still owed quite a bit of money. Have you ever seen that?
Yes. And I like the comment you made in the last podcast. Your note that's due doesn't care whether it's January or February.
Okay. Well, is there anything you wanted to move on to next or?
No, I just want to follow where we're going with this because I love how you can kind of play around with scenarios on this calculator and see the true impact on everything. The thing that I'm still interested to see is the idea of the write-off that gets so confusing and how you're breaking that down to understand what that truly means.
Well, yeah, and honestly, that's next in this line. I think that's part of the punchline that people really need to see. We talked about this financing, what does it cost us? And just thinking about, can I afford that monthly payment? And yes, if you just play the monthly payment game, you can justify that payment all the time. But as you know, they don't factor in that cost of that insurance. They don't factor in the interest rate on that. They don't factor in maintaining that, whether this is a truck or an excavator. If you got a mechanic on duty, you got to pay that salary. Yeah, it may be cheaper than sending it out to a service, but whether you got that mechanic or not, it's going to cost you money to repair it, to maintain it. That leads into the lease versus buy. And we're going to get into this one, but I know originally when you kicked this to me, you were talking about your own personal car and you were more talking about, okay, should I just buy another one or repair it? And we'll come back to the repair versus replace. Do you see people leasing versus buying or renting the equipment part of the job? What's your thoughts?
I think some are just looking toward the lowest monthly payment to get what they need. That's it. Others, especially general contractors, at least most of mine, don't have a whole lot of equipment. The main thing that they're buying or leasing are their pickup trucks to get themselves and their project managers around to the different projects. But at the same time, even that decision kind of comes with your feeling about the reliability of the vehicle. And most contractors test that, just like outboard motors. Back when Yamaha and Mercury were fighting over who produced the best outboard motor. Well, you and I both know that things that are made for commercial use are built better than just for the average market.
Yeah, absolutely. When it comes to leasing it versus buying it, part of where I'm going with this calculator here is if you're talking about a truck or a vehicle or whatever, a lot of times the lease payments are cheaper than buying it. When we talk about equipment, a contractor says my loan payment on that is going to be cheaper than renting it, especially if you renting it from an equipment dealer or whatever that's going to maintain it and all that stuff. Obviously, it's going to be cheaper. The thing about that is just making that comparison. Honestly, we can change the terms as much as we want and have the lease versus buy from a cash flow standpoint essentially turn out how we want it to.
Right.
We can say, okay, well, we got this $80,000, $90,000 truck, or let's just stick with the same $80,000 truck.
Or better yet, Wade, most contractors aren't going to lease a vehicle, they're going to lease equipment because they put so many miles on their trucks.
Yeah, and as we get into it, when you get into vehicles, you lease the truck and you burn that thing up. A lot of them have caps on how many miles you can put on it and what the residual value is. And sometimes you got to come to the table to turn that thing back in.
Mhm.
So that's also something you may have to take into account. But again, we don't necessarily need to play with calculators, but we can change our payment. Well, we put more or less down, right?
Mhm.
They might play with the interest rate. You were talking about, I think last episode, these dealers will give me a 0% interest rate. They're capturing that somewhere.
Yeah, the price of it is going to be higher. And it's also
Yeah.
going to be, you have to say, is this just something they want to get rid of? They can't sell it?
Yeah, you got to think about that down the road, and they're thinking about that. But it's amazing to me that it's like these lease terms. I remember used to be like you could only get 60 months, but when you got a $150,000 pickup out there, people are easily running 66, 70. I see 72, or even I've seen up to 84 months. So as we said, we can run it out 84 months and make that monthly payment cheaper than a leasing. But by the same token, the leasing guys can do the same thing.
Mm-hmm.
And sometimes it's just, okay, we're short-sighted that the interest rate is this, that's going to play into it. How long are we going to lease it? 36 months on that vehicle. But in that time, we're going to burn up 150,000 miles. But the residual value on that, we're going to have to come to the table with a certain amount because we've gone over that 15,000 mile a year cap that they got on it. I mean, what contractor I know of runs 15,000 miles in a year on a truck?
Never met one. Yeah.
So I was playing with this. I really wasn't showing down here, but as we play with this, you can play with the numbers and the lease versus buy from the cash flow effect. Are we building equity? We can play with that cash flow all day long. And sometimes that's not really what we should be thinking about. Well, you do need to be thinking about, can you afford it? And so this is where I think a lot of people really don't, okay, just can I afford it in the moment? I need it. You ever hear that? I need it. I got to have it.
Yeah, I need it. I got to
Well,
have it. I'm just going to try to get the best deal I can.
right. Sometimes they will play with numbers depending on what they've got to work with. But sometimes what we're going to find out later is that it can come back to bite us. So now I want to move on to that repair versus replace.
Okay.
And originally, I think this is one of the things that you and I were kicking around about your car.
I don't mind plugging my own information in here. I've got about $3,000 worth of future repairs to do to my vehicle that I know of, not emergency repairs. Vehicle's paid off. Love the vehicle, but because it's German engineered, it costs more to keep running, serviced. When parts go bad, need to be replaced, they're expensive. Buying a new one and not worrying about the maintenance of it and having all the new technology that comes with it. What's my value of that? Oh, these were the questions I was having as I was trying to decide whether to keep my vehicle, put the money into it. What it's worth is negligible. That just doesn't mean anything to me. The cost of driving something and the dependability of not breaking down out on the road and then saying, what's it going to cost me to put another 100,000 miles on this thing? It's truly what I'm looking at. And then you look at buying a new vehicle, it's like, man, I don't want that debt. I don't have it now. I don't want it in the future.
Well, I think you were talking about the average price of a vehicle now. I know we were talking about like 50 grand is easy to.
Yeah. And you just walk into any equipment dealer or automobile truck dealer, and the first thing the salesman asks is, what can you afford a month? Once you give them that information, you're dead. Because it's amazing how they're going to use these type of calculators with their own profit margins in there to tweak that thing to get you where you want to be.
Absolutely. And as we talked about in the last segment, it was like, okay, yeah, we can play with numbers all day long. And those dealers, whether they're leasing it or buying it, and we didn't really even get into the operating lease versus capital lease and those kind of things.
I love the downtime calculator you have here.
Contractors definitely need to think about that. It's one thing you got a truck and, that truck's not on job site, but you got an excavator. If you got to repair it, and I've seen some waiting on parts, equipment down 2-3 months because they can't get the parts. You don't think about that. And it's like, okay, well, there's a truck. You got to rent something to temporarily do something. But if it's on the job site, you're going to have to rent something. It's probably going to cost you something. And people don't take that into account. The idea is, what does it cost to keep this equipment? And if it does go down more often than not, how many downtimes are we going to have per day, per year, whatever? What is it going to cost to repair it? Right?
Right.
Versus if we replace it with new, okay, I don't want a monthly payment. So you're going to put a whole bunch of money down. It's a lot of money out of pocket. As we said, we could play with this monthly payment, and those dealers will play with that payment. Maybe the maintenance on that is not going to cost you near as much as the annual repair costs on the other one. But as you said, your downtime, you may have 1 or 2 days of going to get your oil changed. I don't know. I'm just making stuff up. Again, depending on where the numbers fall, you can see this is a repair versus a replace decision. And if you're strictly looking at economics, yes, you can make a mathematical calculation, but whether that headache of having the downtime, whether you can deal with that from mathematicals, I don't know if this plays into your decision or not, but this was the idea behind this calculator. Is like, okay, we could take some actual numbers and see what makes sense. This was thinking, okay, I bought it this year, 1 versus 2 versus, how long can we keep that truck? And it's just a model, but hopefully it's leading up to something bigger that we're about to get into.
I can't wait to see that. And as I'm looking at this and analyzing it, I'm thinking, okay, we've got insurance. And then we got another question is how many people out there can work on this particular vehicle or piece of equipment? That's a huge question. How hard is it to work on it? Who can work on it? How hard is it to get parts? How durable is it? These questions, I love it that we can take this calculator and at least make a decision based on the hard data of the cost.
Now that I'm showing the whole thing, like I said, at some point, it's like you keep repairing and then get mathematically, at some point, it's like, well, now it's time to replace. But if that's all you take into account, it's somewhat short-sighted as well. But at least you're making an informed decision.
Right.
So if it's okay, let me go ahead and go into the main thing I want to talk about today. This is the math that nobody talks about. We talk about Section 179. That's the IRS section where we talk about, I could buy it on December 27th and write the whole thing off even though I haven't made a payment on it. There's also Section 168K. That's like bonus depreciation. You may hear about that, especially the big beautiful bill came out. Most contractors are not coming close to the caps on being able to write any of this stuff off. The recapture part of this is the thing that I think people do not understand. We could say, okay, well, we got that same $80,000 truck. Let's just say you're in a 35% tax bracket. You make a down payment of $10,000 and then you got a 7.5% interest rate and 72-month terms. So your monthly payment was only $1,210. And then I decided to sell it in year 2 versus year 3. Let's just stick with, say, year 3. In year 3, let's just say it's worth $45,000. What have you paid on your loan so far? In this case, you've made $53,000 in payments, but you still got $38,000, $39,000 loan balance on it. A lot of times when people are churning these up, you've got more of a loan balance on it than it's actually worth. I haven't really done any real scenarios, like take a specific truck or something like that and what it would be worth in year 2, 3, or 4. What I'm trying to get at in playing with these numbers is this is the math that nobody shows you, okay? From a cash standpoint, $10,000 out of pocket, and you made 24 payments, that's $29,000, but you wrote the whole thing off in year 1. That's a $28,000 tax savings. And then we've got $45,000 in year 3, but the payoff is $50,000. Not to mention, this is the part that nobody understands, is you have recapture tax. So when you wrote that $80,000 truck off, you depreciated 80,000. So you have zero cost left in that truck. Every bit of that sales proceeds, that $45,000, is going to be taxed, not at capital gains rate, it's ordinary income rate. That's another $15,000 in recapture tax. So your net cash position, you are out $20,000 versus, let's say, okay, we did the same thing and we just did the regular depreciation for it. We did the same $10,000, we're out $10,000, no payments on it at the same time. We've only saved 14,500 or so because we didn't write it all up front, but over a couple of years. And then we get this same $45,000. The loan payoff is still $50,000, but the tax on the gain, instead of being $15,000, is $2,300. So in the scope of things, we are more than 13,500 better off.
By not taking that huge write-off.
Yeah, I don't think this one really captured the fact that when you drive that truck off the lot, especially year 2 or whatever, that drop in value, it compounds that situation where we get upside down on the trucks and we're basically cash out of pocket and we're continuing to have to do. And I could show all the calculations that go behind this. I can back them all up, but hopefully you're trusting where I'm going with this. This essentially is the part that I really wanted to talk about. The main thing that is hidden behind the scenes is you're paying that recapture tax years down the road, and it's hidden because we've already covered up with buying another truck. But in the meantime, we're getting negative equity, and this starts that cash flow spiral for these contractors.
It's absolutely wonderful to see this in front of my eyes because so many contractors are having a great year, and with percentage of completion accounting, you can defer some projects over into the other fiscal year end to spread that out. But eventually you're going to owe and have to pay these taxes. You can only defer them so long. And then all of a sudden, everybody else is saying, well, you had a great year. You need to expense a lot of stuff before the year end, or you're going to have a huge tax bill. And that's the logic. That's the advice that they're getting from their friends, maybe not their CPAs.
Well, most of your CPAs are going to tell you the same thing because that makes them the popular CPA. There's out there saying, okay, well, we can get you all these credits. And
yeah, it'd also be good if your CPA was your hunting and fishing buddy and drinking buddy and so forth. I mean, seriously, you're right. It's what makes you popular. Telling people what they want to hear. Gosh, like a politician.
I work for CPAs like that. That's the expectation of me. It's like, okay, you're going to save me all this tax. But when I started looking at the long-term effects of it, I'm not saying you shouldn't ever do this. One of my favorite clients actually called me out because he listens to the podcast all the time. He's like, I know you're going to kill me, but I need to buy a new van from a fleet. And I'm like, that's not the point of why I'm saying this. You got to do what you got to do. But making smart decisions is what I'm about. I probably should do some kind of follow-up on this, but this is how we end up in these negative positions where we get that spiral. They spiral on our cash flow, and good contractors that have been around for a long time just can't continue to run. I've seen some contractors 4 or 5 years and they'll run it out and it's like, okay, we'll bankrupt it and start a new one. You're smiling, but you've seen that too?
Oh, yeah.
I really enjoyed building it from that perspective because I've never really shown some of these things. I know we need to wrap up, but that's that boomerang that I was talking about, where it comes back to bite you and you don't realize that it's even hit you because it's buried in everything else.
I love it. Thank you, Wade. I think our listeners are going to get a lot out of this too. And it's not about your CPA. I would be very comfortable hunting and fishing and drinking with you if I did a lot of that. I would be very comfortable doing that with you. But you get what you pay for in advice. And the question is, do you want the advice you're paying for? I literally give customers advice on things and they don't want to hear it. It's like, am I going to back down from that? Or I'm going to just stay the course and give them the best advice I know, no matter how it affects us or our relationship. And that's kind of the path I've taken. It's easier as you get older, isn't it, Wade?
Yes.
Our job is to give good advice. That's what we do. We try to do.
Well, again, I know it doesn't make me always the popular CPA, but tell people this when I can actually show them how they've gotten into this cash flow spiral. To me, that makes a lot of sense.
Right, right.
We can have all people say, I'll make sure you never pay any tax and I'll come up with all these credits. But again, I know we're getting really long on this episode.
No, but one
I've
other thing
enjoyed.
I wanted to say, Wade, is you get this spiral that occurs and then they come to you and talk to you. And you were able to go back and deconstruct that spiral, how it happened, what decisions were made. And no matter what situation you're in, then you say, okay, now let's go forward. Let's look at it this way. Let's look at it that way. That's the real power in having good information and being able to understand your numbers. I was thinking of the practical side of construction. Everything is about numbers, everything is about managing risk. And I just hope our listeners can appreciate the fact that we're just trying to give them information out there because it's the small things that can just do you in our business.
Well, I appreciate you kicking this around. You actually kicked off the conversation, so I appreciate it and allowing me to expand on some of this stuff. But just thinking solely for a tax deduction, sometimes that's a short-sighted decision. Thinking about something for the long-term health of my company, and we get short-sighted. I've enjoyed this, and I had people when I show these calculators, they want a copy of it. I'm gonna talk real soon about how you can get access to these type of calculators from me. If nothing else, I hope you took some thoughts away from it. Repair, replace, lease, buy. You got cash flow decisions, you got tax decisions, you got your overall health decisions, you got your bonding decision. I mean, as you said, you're not going to bond somebody based on how much equipment they got in the yard, right?
Never.
Never. So, if you had any thoughts, any questions about what we talked about, Stephen and I would love to hear them in your comments. We always appreciate if you like, share, subscribe. That always helps the channel out, and we do appreciate it. We do this every single week, and we will see you in the next show.